Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting company narratives through a serious structural stress test. I'm your lead analyst. Today, we're putting on our hard hats and heading to the construction site for Dycom Industries. Now look, this stock has been on an absolute tear, of over 150% in the last year alone. They're literally building the backbone of our digital world, laying the fiber and wiring up the infrastructure we all depend on. But here at Iron Financial, we're here to ask the tough questions. Are they really building a digital empire with a rock-solid foundation? Or is this all just a magnificent house of debt, one that looks great on the outside but is just waiting for the first strong economic wind to knock it all over? Let's find out.
Okay, so let's get right into it. You know, every bull case, every single one, starts with a blueprint. And this quote right here from President and CEO Dan Peyovich, this is it. This is the official blueprint that management is handing directly to Wall Street. Let's break it down. Record year, rampant growth, margin expansion, and increased free cash flow. I mean, this is the architect's rendering. And folks, it looks like a masterpiece. It's glossy, it's impressive, it's everything you want to see. But our job isn't to admire the pretty picture. We're here to check the rebar, look for cracks in the concrete, and see what's really holding this thing up.
Exactly. Here at Iron Financial, we don't just take the builder's word for it. We bring our own tools for a full top-to-bottom inspection. So here's how we're going to do this. First, we'll get into the Q4 scorecard. We're talking about the core materials they're using to build this thing. Then we're going to examine the big, shiny new expansion, their huge power play into the data center world. After that, we are heading straight down to the basement to inspect the foundation, specifically the heavy debt load that's holding it all up. From there, we'll review the inspector's report on the path forward. What does the future actually look like? And finally, we'll weigh all the evidence and deliver the iron verdict. So let's grab our gear and see if this structure is truly sound or if it's all just a pretty facade.
That's right. We start with the facts on the ground. We have to look at the raw materials that were reported in their Q4 earnings. You have to understand this is the absolute foundation of the entire bull case. It's where we have to begin our drill down. Because if the concrete mix is weak right here at the start, then the entire structure, no matter how tall it gets, is already compromised.
So our inspection starts right here with the core materials. And let me tell you, on paper, this looks like some high-grade stuff. First, a solid beat on the top line. Revenue came in at $1.46 billion, crushing the $1.33 billion the analysts expected. That's a big beat. Then you look at the bottom line, the earnings per share or EPS. That's the company's profit divided by its shares. They delivered $2.03, which again was well above the 180 estimate. So top and bottom line beats? Check. But the number that really provides the structural integrity for this incredible stock rally is that year-over-year revenue growth, a massive 34.4%. And get this, even if you strip out the effects of their recent acquisitions, the core underlying business grew organically by over 16%. This isn't just passing inspection, this is blowing the stress test to absolute pieces.
And this is the crucial point for anyone looking at this company. This wasn't just a flash in the pan. It wasn't just one lucky quarter where everything went right. A single pillar can look strong, sure, but you need an entire foundation to build on. And that's what we see here. The fourth quarter was simply the final capstone on what turned out to be a record-breaking year for Dycom across the board. They weren't just finishing up a small project. This was like cutting the ribbon on an entire skyscraper they just spent a year building.
Now let's drill into the full year picture, because what's really interesting here is the relationship between these numbers. You've got contract revenues for the full fiscal year up almost 18%, landing at $5.55 billion. That's really strong growth for a company this size. But look closer. Look at the adjusted EBITDA. Now that's just a fancy term for earnings before interest, taxes, depreciation, and amortization. And it's a key measure of a company's raw operational profitability. And that figure grew even faster, up a whopping 28%. Now what does this mean? It means their profit margin expanded by 105 basis points. That's just over a full percentage point. For investors, this is the holy grail. It is the sign of a well-oiled machine. It means for every new dollar of revenue that comes in the door, more and more of it is dropping straight to the bottom line. It's a testament to operational excellence and efficient project management.
All right. The numbers are impressive. I'll give you that. The materials look good on paper. But you have to remember, any contractor can look like an absolute genius during a building boom. The real question is, what happens when that boom inevitably ends? Is this explosive growth just Dycom riding a cyclical wave of telecom spending right to its peak? Or do they just go out and install a brand new, high-powered engine that can actually sustain this kind of momentum? We need to know what is fundamentally different now compared to a year ago.
And you know what? That is the perfect question. It is the question. And the answer The entire bull thesis for the next phase of this company's growth rests entirely on a massive strategic move they just made. See, they didn't just add a new coat of paint to the building. They've architected an entirely new wing of the company, a wing specifically designed to tap into what might be the single biggest construction boom of our lifetime, the build-out of the digital world driven by AI.
This brand new wing was built with a single, absolutely transformative acquisition, a company called Power Solutions. Now listen, this isn't just another small tuck-in purchase they do all the time. This is a game changer. Power Solutions specializes in building the incredibly complex electrical guts of massive data centers. Think about it. As the AI boom demands more and more power and more data, we need more and more of these data centers. Dycom essentially went out and bought the company that installs the entire central nervous system and the power grid for the AI revolution. It's an absolute masterstroke to tap directly into the hyperscaler build-out.
And you better believe this wasn't an accident. This was a calculated three-step blueprint designed to rewire the entire company for a new era of growth. Step 1. Go out and acquire the expertise you need with Power Solutions. Just buy it. Step 2. Don't just absorb it into the old business. Create a brand new building systems segment to give it focus, identity, and its own P&L. This signals to the market that they are deadly serious about this new business. And then step 3. Unleash this powerful new division to directly target the hyperscalers. We're talking about the tech titans with practically bottomless pockets who are in a desperate arms race to build out their AI infrastructure. It's a deliberate, methodical, and incredibly powerful strategic pivot.
And the impact of this move isn't some far-off dream 5 years down the road. It is immediate, and it is massive. You just have to look at management's own projections for the upcoming fiscal year, 2027, to see the story. This brand new building systems segment is projected to do $1.2 billion in revenue right out of the gate. I mean, to put that into perspective, that's going to be over 15% of their total expected revenue in its very first full year of operation. This is from a business they didn't even own a few months ago. This isn't some side experiment. It's a fully operational billion-dollar growth engine they just bolted on.
Whoa, hold on a minute. A billion-dollar business they just bought? Let's not get carried away by the shiny new object. That chart looks fantastic, sure, but it hides two absolutely critical questions. First, what was the price tag? How much debt did they have to take on for this supposed masterstroke? And second, and this is a big one, can a company that's an expert at laying fiber optic cable in the ground truly and effectively manage a highly specialized electrical contractor for data centers? Or did they just massively overpay to bolt on a trendy business, creating a costly and complex distraction from the core work that, by the way, still makes up 85% of their revenue?
And that is the perfect transition. The new wing looks shiny, it looks promising, but now it's time to do what we do here at Iron Financial. We're going down into the basement with a high-powered flashlight to check the foundation. Because all of this heavy lifting, this massive company-altering acquisition, it comes with some very, very heavy debt. Let's see what's really holding this thing up.
Now, before we look at the debt itself, let's talk about the engine that has to service that debt. And this number right here is the absolute core of the bull argument on the balance sheet. A record $435 million in free cash flow. This is the pure, unadulterated cash profit the company generates after all the operational bills are paid and all the necessary investments in trucks and equipment are made. It's the lifeblood of the company. It's the cash they can use for anything, paying down debt, making new acquisitions, or returning capital to shareholders. It's a powerful sign of a healthy, well-run, cash-generating operation. A healthy operation, you say? Well, that healthy operation just strapped a rocket engine of pure leverage to its back. And here's the bill. Total long-term debt went from a pretty manageable $933 million last year to a staggering $2.81 billion now. Let that sink in. That is a tripling of the debt load in a very short period of time. That is an immense weight for any foundation to bear. So the central question of this entire stress test is right here, on this slide. Is a $435 million cash flow engine powerful enough to support a new $2.8 billion mountain of debt that's now strapped to its foundation?
Look, from my perspective as an analyst, this is the definition of smart leverage. This is what smart companies do. They're using debt as a tool to acquire a high-growth, high-margin asset that will generate even more cash flow in the future to easily service that debt. Their liquidity is strong, the foundation can absolutely handle it. Handle it. They've tripled their debt practically overnight. That's not a tool, that's a potential wrecking ball hanging over the entire structure. Yeah, sure, their assets doubled, but so did their liabilities. They have fundamentally changed the risk profile of this company. So the question isn't whether it's smart, the real question is whether the potential reward from this data center play is actually worth the massive new financial risk they've just piled onto the foundation. Because if that new segment stumbles even a little, that debt becomes a concrete anchor, not an engine.
Okay. The debt is significant. We've established the risk. I get it. But a smart builder, a smart management team doesn't take on that kind of heavy load without a very clear plan to support it. The path forward, as the company argues, is already paved with a massive and growing backlog of contracted work. So let's move on and look at the official inspector's report on all the future projects already lined up. And you know what? This report looks solid. The total backlog has absolutely swelled, growing 23% year over year to an enormous $9.54 billion. Let's be very clear about what this is. This isn't some forecast or a hopeful estimate from a sales guy. This is a pipeline of signed contracts for future work. This is the visibility that gives management the confidence to go out and take on that kind of debt. It represents future revenue already under contract. You could say the steel frame for the next several years of growth has already been delivered to the job site.
See, a backlog is just a plan. It's a promise, not a payment. In the construction world, and definitely in this business, plans get delayed all the time. Budgets get reevaluated. Macroeconomic headwinds can suddenly cause major customers to slow their rollouts or cancel projects entirely. So the question is, how much of this $9.5 billion is solid steel, I'm talking firm, non-cancelable commitments, and how much is just a pile of rebar waiting for concrete that might never get poured if economic conditions change? A big backlog number always looks great on a slide, but it's the quality of that backlog that truly matters.
And management is addressing that concern head-on. They are putting their reputation on the line with very strong forward guidance. They are basically telling the market, don't worry, we can and we will pour that concrete. They're guiding for total contract revenues of around $7 billion for fiscal 2027. That represents significant growth right on top of a record-breaking 2026. This is the kind of confidence that comes from a team that sees a torrent of demand coming from both their legacy fiber deployment business and their brand new data center segment, and they believe they have the operational capacity to execute on all of it.
Okay, so management might be confident, but Wall Street is completely, utterly divided. And for me, this is a massive red flag. On one side, you have the bulls, like Bank of America, raising their price target all the way to the sky at $475. But then, on the other side of the street, you have a firm like Zacks Research looking at the exact same data and slapping a strong sell on the stock. You even had a negative earnings ESP. That stands for Expected Surprise Prediction, and it's a metric that compares the most recent analysts' estimates to the consensus. And it was suggesting that the smart money was actually betting on an earnings miss. This isn't just a minor disagreement over what color to paint the walls. This is a seismic fault line running right through the foundation of the entire bull thesis.
All right, we've done the work. We've examined the blueprints from the CEO. We've inspected the record-breaking quarterly and annual results. We've analyzed the shiny new data center wing. We've stress-tested the debt laden foundation, and we've reviewed the conflicting, confusing reports from Wall Street. So now, it's time. It's time to weigh all the evidence and deliver the iron verdict. Is Dycom a well-constructed opportunity for your portfolio, or is it a carefully disguised trap? Okay, let's be perfectly clear. The ironclad strengths here are undeniable. You have record-setting growth in revenue and earnings. Check. You have a brilliant strategic pivot into the white-hot data center market. Check. You have a massive, nearly $10 billion backlog that provides incredible future visibility. Check. And you have a powerful free cash flow engine that's funding the entire operation. This is the foundation of the bull case, and it is built on solid rock. But the potential cracks in that foundation are just as real, and you cannot ignore them. That massive new debt load is a serious structural weakness. The risk that they failed to properly integrate the huge Power Solutions acquisition is significant and very real. The conflicting signals from Wall Street analysts show that there is absolutely no consensus on what this company is worth. And finally, after a 155% run-up in the stock price, you have to ask yourself the most important question of all. Have investors already paid for a perfect, flawless execution, leaving zero room for error? Have they priced the structure not for what it is today, but for what they hope it will become tomorrow?
And so that leaves us with our final question for you to consider. Dycom has, without a doubt, laid an ambitious and exciting new foundation for growth. The blueprints look incredible, the potential is enormous. But, as we've seen today, this project carries an immense amount of weight. The heavy weight of a tripling in its debt and the towering weight of Wall Street's sky-high expectations. So is the framework they've built truly strong enough to carry it all? That's the multi-billion-dollar question you have to answer for yourself before you decide if Dycom is a solid cornerstone for your portfolio or a house of cards built on a mountain of debt.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.